Let's discuss the macro picture for Indian economy with a very special guest, Chetan Ahya, Chief Asia Economist with Morgan Stanley. He joins us on the sidelines of the 16th Annual Morgan Stanley Conference. Chetan, fantastic to have you back. Thank you for joining us. Let's start with the big story, and the big story is that Reserve Bank of India Governor yesterday has maintained status quo. He is not ready to ease the leash. However, the accompanying commentary, the accompanying dovish commentary was a real bonus.
Honestly, Nikuj, I think that you guys in media try to make too much out of the statement. You have to conclude either it's dovish or hawkish. I think it's kind of firmly neutral. I wouldn't really count it as a dovish statement, honestly, because I think he's mentioned about the upside risk to inflation. He's mentioned about the downside risk to inflation. So we put it as status quo, neutral stance. And that, you will probably get to watch the inflation numbers, and then once inflation numbers gives either upside or downside, that's where the monetary policy will move. Our own view is that the trajectory that RBI has forecast, that is something that we believe is very much achievable. So at this point of time, we are looking for any kind of easing happening only somewhere in either February 2015 or April 2015, but more likely April 2015.
Chetan, let's talk about growth, considering in your article yesterday in the Economic Times, you've talked about, 3 success factors that are going to propel India higher. Highlight for us what might be we see the growth next.
Recovery. GDP growth recover first to 5.6%. Forward 6.8%. By March 16. So essentially a good cumulative increase over the next 7 quarters, but in the initial few quarters we'll probably have it around 5. So a gradual recovery supported by first recovery in exports. Exports in the month of March 14 were minus 1%. We expected that to grow to plus 10% by March 15. And then as the confidence improves, we see a first round of improvement in capex in brownfield capex rather than greenfield capex, because a lot of the companies actually could do capex and had the cash but did not have the confidence. So the elections outcome has been positive. We now expect that business confidence to revive brownfield capex after 2-3 quarters. So initially exports, and then also backed up by some kind of brownfield capex by the corporate sector.
The case that the growth trajectory in FY15 is unlikely to kick in. The big kicker will only come in FY16 when the administrator, which is the NDA government, they would be able to materially, move things around.
Yeah, that's right. I think, in the initial phases, we do have some constraints in place. We know that interest rates are not going to go down quickly. We know they have to manage fiscal deficit tight. And we know that exports have just been reported at minus 1%. That's not going to recover very quickly either. So I think all the constraints that we have in place will mean that we will have a recovery which will be relatively slow. Moreover, as regards capex is concerned, I think there is a big confusion in terms of the pace of recovery and the magnitude of recovery. Our view is that in the initial phase, India needs to actually see an improvement in the capacity utilization, or call it capital productivity, because at the current level of capex that we have in the country, which is 32% of GDP, we should have been generating something like 7% GDP growth. So in the first phase, what we have to do is to improve the productivity of existing capex, and then that's how we'll probably get a bigger recovery in capex in the second phase. Banks have tight LDR ratios. Industrial companies' debt equity ratio is at 2:1. So I think we need to be a bit more realistic in the pace of recovery in capex that we are building in. And that's the reason why we are saying it's going to be more F2016 when you get a proper recovery in growth and investment.
Chetan, in terms of the growth dynamics, and now with a firm political mandate in place, what's the sense that you're getting, post day one of your conference? Are people extremely enthused, and is there a sense that, India perhaps is relatively best positioned amongst the entire emerging market basket, and money is going to move out from China, Brazil and Russia and perhaps find its way into India? Is that the sense that you're getting at all?
See, there are two groups of investors which are right now in play. First is the emerging market dedicated investors. I think those investors have got a decent positioning in India and in some ways are enjoying this rally. But there is a big class of global investors which have not really invested fully in India. And for them, it's a different perspective. They are looking to buy in dips. But the emerging market dedicated investors are somewhat more now kind of, I would say, neutral because they feel that the markets have rallied and they have already participated in it.
Chetan, for the moment, everyone has written an obituary for the dollar. The consensus view is that the only way rupee will move, that it will appreciate. Is it too naive to assume that? Because if the Indian economy picks up, the first thing that will change is the oil import. The oil import bill for FY15 was up by only 2%. But if the economy recovers, oil import bill will expand. And if the oil import bill will expand, the demand for dollar will automatically increase.
Not only oil exports, it will also be the other imports, but the other imports like capex goods, which has been quite weak. So yes, we do think that the current account deficit will expand from the 0.2% number that we've seen towards more closer to 2% over the next 4 quarters. And that will begin to demand, that will need to be fixed in terms of funding by dollars. So therefore, we do think that the rupee will actually be on a gradual weakening path after this initial bout when there is strong capital inflows and current account deficit in the next 1 or 2 quarters would not have been high enough to offset that capital inflows. So yeah, I think underlying the rupee actually needs to be weaker. The technical factors, which is that a lot of capital inflows are coming in the context of current account deficit, which is low, will have some upward pressure on the rupee. But over the next 4 quarters, we would build in for some kind of weakness emerging back in the rupee dynamics. Also because the trade inflation differentials between India and its trade partners warrant the rupee to be weaker. So today, trade partners' inflation is around 3%. India's inflation over the next 12 months would still average around 7.5, 8. So in that context, the rupee actually needs to be weaker so that we maintain our fair value of the rupee and ensure that our competitiveness is not lost. And not surprisingly, the RBI governor some time back had indicated that 55 is too strong. So we think RBI is on the right path in terms of managing the rupee, not allowing it to appreciate too much. Otherwise, it will cause problems on competitiveness.
So Chetan, as an Indian living outside India, what do you think should be the new government's top priority at this juncture? Because a lot of people are talking about reforms and, others are talking about bringing inflation down, getting the growth engine back. What, according to you, should be the first set of issues that the new government needs to address?
I think the most important issue is inflation. There is no starting point for recovery in any country without having inflation in control. So we think inflation is supposed to be the most important point that the government should focus on. The reason why I'm saying that is if you look at India's growth rate, even today, at 4.6% growth rate, when you compare with the rest of the world, 4.6% is not that bad. Only China is able to match this in terms of higher growth rates than India. But the problem that we have is that we have got high inflation accompanied with it. So that stagflationary type of environment is extremely adversarial for investors. So if we can get inflation down to 6% and GDP growth to 6%, that combination will make it very powerful for India to be one of the attractive investment destinations. So from thinking from investors' mindset, I would say inflation is most important policy focus that the government should have.
Someone once told me that right now we've become a 4 to 9 economy, which is 4% GDP growth, 9% inflation. What we need is a 9 to 4 economy, which is 9% GDP growth and 4% inflation. But keeping that part aside, final question. Do you think the India appeal, irrespective of what happens in the short term, what happens in the medium term, is now very strong? Because India is one domestic-driven emerging market where the rate of change is going to be very strong. So in the short term, things will not move. But after the election verdict, and it is what is considered to be like a generational shift, do you think the India appeal is not going to die down anytime soon?
Sorry, I couldn't hear the last part of your question. The voice was
I'm a global
cracking. You mean
investor.
to say whether the India story is long-term story is intact?
No, what I'm trying to gather from you, Chetan, is that in the short term there are a lot
global
of
investor.
Yes, go ahead.
No, I guess you're questioning about the long-term outlook. Is that intact, right?
Please.
Hello?
Right. Chetan, let me just rephrase my question. My question is that do you think irrespective of what happens in next one quarter, next 2 quarters, do you think the India appeal is going to be very strong? Because India currently is one large domestic driven emerging market where the rate of change in the foreseeable future is going to be very strong.
Yeah, absolutely, Nikunj. I think that's what we highlighted in our big report, which is the next India, and I think I covered briefly in your interview about 2 weeks back. So essentially what we are forecasting is that we think India's GDP growth will average 6.75% over the next 10 years. If in the background we can bring down our inflation closer to that 5 to 6% range over the next 2 years, then it will make India as one of the highest productive growth countries. We may have some other countries which deliver higher growth rate, for instance China, but the question would be whether those growth rates are productive enough for investors to find it attractive. For instance, what we are finding in China today is that its GDP growth is probably around 7.3, 7.5, but you have accompanied with that macro instability issues like PPI, which is Producers Price Index, which is in deflation. And that is making it very difficult for investors to make money because it's not generating adequate nominal GDP growth and corporate revenue growth. So if India can manage its inflation lower along with that acceleration in GDP growth rate, which we think it will then become very attractive for global investors, and it will continue to emerge and find its place in the global asset class.